So if you think what this thing is, it's a share of these networks. If you're one of the 300 million, this is why you need to keep hold of this stuff and stop fucking around with it. Is if you are one of the 300 million, and behind you, we've got 4 billion buyers to come.
Yeah.
Why the hell would you sell it? Yeah, and you will see some of that in Dubai because rates go up and everything else. So you will see some of that, and you've got the inflation issue, but you have these secular things that balance it out. The US, for example, massively overbuilt property in too short a period of time because they extrapolated the trend rate of growth after lockdown when everybody bought a new house and wanted to move out of cities. They assumed that was normal, but don't forget rates were almost zero. We then had a rise of rates that mortgages are now higher than they were in 1996. So suddenly everyone's like, oh shit, I can't pay my mortgage. But the price of their shopping in the supermarket has gone up huge too. And so suddenly it's like, oh, I've got no income left out of my paycheck. What do? Do I get rid of my property? Well, property prices are starting to fall. Or do I stop any other consumption? And we're seeing that all over the place, where people are like, I can't afford to do that. It's one of the things that actually hit the crypto market. Because many people were dollar cost averaging with a bit of excess cash. They put it in, like good investors. Problem is, suddenly they've got no excess cash, and you kind of took a whole bunch of buyers out of the market. A lot of this stuff is down 80%. Things like Shopify or whatever it may be. So that gets really interesting. And crypto's the same. It's even got a faster, steeper curve over time. More and more people are flocking to it. And the prices are down 80%. Well, between 50 and 80%. So these are the times where, let's say there's another potential 50% downside, let's say, because crypto is very volatile. What is the upside? Usually when you get to this kind of oversold levels, so I use stuff like the 5-year moving average, you find that the upside is 10 to 20x. So you've got a 0.5 downside, 10x upside, right? These kind of things don't happen many times in your life. So if you do have a bit of cash, buy what everybody's sold, not what everybody's buying now. And everybody's buying now. If we're talking about Dubai, people are buying property. Okay, that's been a good trade, but is it likely to generate 10x? No chance, never. So then when you're looking at the risk, what happens is people they suffer two things. One is the illusion that, Ethereum's at $2,000, whatever the number is, or Bitcoin's at 20,000, 30,000. I can't afford one, right? Which is a complete misunderstanding. They all fractionalize down to like 8 decimal places. What that means is you, me, the 23-year-old who's got, $50 a month to put in the crypto market can all put the same percentage of our disposable income in and all benefit to the same percentage, which you can't do in other things, right? There's a lot of things in most financial markets that you don't have that equal playing field. So everybody can participate. So that's great. But everybody has this illusion about price. It's like, well, I can't afford a Bitcoin. You don't need a Bitcoin. You just buy whatever you want to do. Secondly, there is this illusion that everybody else is making money in these small tokens, and you see it and it seems fun and exciting and gambling, and you kind of want to do it, and it gets your blood. Oh, I need to do this. Everyone's making money in the metaverse and I'm not. They're making money in this NFT and I'm not. And it's FOMO. Now, it's actually fun in the space, the FOMO and the ridiculousness. And people joke, laugh with each other. I mean, we've got here at Real Vision, one of our Slack channels internally is like filthy degens because people are degenerative and they kind of embrace it. How I would approach this is understand that all of that degen trading of the NFTs, because in NFTs it's harder to own the really kind of the real valuable assets. So you're involved messing around with a bunch of communities in pump and dumps and all of this. These small tokens, knock your socks off, but do it with 10 or 20% of your savings, of your capital. The rest you allocate into the safer assets, whether it's Bitcoin, Ethereum, Solana, Avalanche, some of those big layer ones where you've got a higher probability of success. And again, the risk curve is Bitcoin is the least risky, Ethereum the next, then there's a whole bunch after that, the kind of Polkadot, Solanas, AVAX. And it doesn't mean they don't come without risk. We learned that from Luna. Things have risk. This whole space has risk, but the least risky Bitcoin needs. So I would construct a portfolio. If you do enjoy the degen activity and you want to enjoy that, I'm going to get rich on this thing, right? It's a human trait. Embrace it. The space embraces it. You ape into tokens, you have fun, you get wrecked. It's all part of it. And it also teaches you lessons. I'm stupid. I was following somebody. I didn't do the research. You learn a lot of good lessons from doing that stuff. And it's a bit boring to buy and hold. I mean, 90% of everything I do is just buy and hold. And I don't do anything with it. And it's you always get a bit of FOMO. So I always have a bit of money for FOMO so I can just mess around and get involved in the community and the fun of it and the movement of it. With the long-term investing, you need to say, my time horizon is, I want to be in this trade for 5 years, 10 years. My objective is to add when it sells off more than 20%. Every time it falls more than 20%, I'm going to add some. And whatever it is, and I'm really wrong if this happens. Write it down and then refer to that every time you think you're about to trade and do something. Because you forget, which I forgot. I forgot that the long-term objective was, because the money was worth more. So I'm like, well, I should save that money. I could take that money off the table. But I actually destroyed my future returns by doing that. And yes, I could have been right. And maybe everything had fallen apart and I would have taken the money off and I looked like a hero. If you're not in it, you won't win it. And that is not true of the small tokens, because we don't know what's got network effects, i.e. what's going to last. Are people going to build on it? That becomes speculation. That's okay, but you need to understand what you're speculating in. But if you're putting your bulk of your savings in, go for stuff that's proven. So right now, Bitcoin and Ethereum are the most proven. Like Solana has mass adoption, but it has issues like the chain break. So you wouldn't want to put all your money in Solana, but if Solana wins the game of mass adoption, okay, they're going to do really well. If Avalanche solves it for speed, they will do really well, but they're yet to be proven by gigantic networks. Well, what I did is also, I took it another way, which was like, okay, I don't know which of these are going to succeed, but I know that DeFi is going to do well. I think Metaverse will do well over time, and I think layer ones and layer twos, let's say. So I just put an equally weighted basket and said, I'm just going to run it and just forget about it. I'll leave it for 10 years, So, you put a bit of Aave and a bit of, whatever it is in, Uniswap, you buy a bit of Mana, you buy a bit of this, and leave it. Now, a lot of people don't like that because it's not trading and it doesn't give you adrenaline, but it gets you to observe the space and you'll see, oh, that's really working. And so that's my strategy with all of that stuff is, if the whole space broadens out to the way we think it will, then many of these will end up doing really well. And there'll be a bunch of new ones that I don't own and don't even know of now. And that's okay. We can't get all of them. You can't live with this endless FOMO. Is this the one? Is this the one? Is this the new Ethereum? Is this the new Solana? I mean, you'll drive yourself nuts. So Ethereum is transitioning to what's known as proof of work, where you get a bunch of miners, which is computers that crunch really complicated maths, use massive amount of energy to prove a cryptographic puzzle, and they get paid. What they're doing is validating the network, and that's how Bitcoin works. And it's very safe, Bitcoin, because of it. But Ethereum is moving to proof of stake, which is different. So therefore, you stake your Bitcoin, your Ethereum, to the network to secure the network. So that means if you're a validator, you have 32 ETH or more, and you get to validate the network and you get paid a yield for it. So the network pays you out of the network fees. And it's a different way of approaching the validation of all of the on-chain activity. Ethereum's no small thing. I mean, it is a gigantic kind of world Web3 computer. So the complexity of doing this transition is one of the biggest feats of engineering, programming development engineering, the world has ever seen. It's gigantic. But September the 19th looks like it's going to happen. Now, will it be 100% ironed out? I think so, but maybe not. Maybe there's some risk. But what happens within this dynamic is, where does that yield come from? And we don't know what the yield is going to be, but it's going to be somewhere, it's going to settle down somewhere between 4 and 6%. Where does that come from? That comes from network activity. And what it does is takes fees from the network and pays it out to the people. But Ethereum also has something called EIP 1559, which takes some of those fees and buys Ethereum tokens and burns them. What you've got, well, they get delivered to a wallet that essentially destroys them. So what you've got is a kind of buyback situation where tokens are being burnt and distributed. So this becomes really interesting. Also, there's currently about 9% of everybody staking their ETH right now, even though ETH staking is not a thing, but there's test nets and stuff where you can do this. The guesstimates are that maybe up to 30% of all ETH will be staked, because that's similar to some other chains. So that when you stake your ETH, it can't be reused for anything. It's not in the market. It can't be sold. It's locked up for a year. It can't be put into DeFi. It can't be put into centralized finance. Nobody can borrow against it, lend against it. It's done. There's less supply. Yeah. Because this whole burning yield stake means that every day there's going to be less ETH than there was the previous day. It's deflationary. So you've got a demand shock. Well, you've got these massive supply shocks. Then you've got a demand shock, which is, well, hell, I want to own ETH because I want to get a yield on it as well. So people are going to come into the market. Then the institutions, let's say Abu Dhabi Investment Authority, well, they're going to be pretty interested if they're making one allocation, which is, we believe in crypto. Before it was kind of, well, we're going to buy Bitcoin. But now it's like, why buy Bitcoin when I can buy ETH because I'm going to get a yield on it? So it's an asset that's making money for me by just holding it, and the asset goes up anyway. It's like owning a technology stock with a 6% dividend or something. So if you think what this thing is, it's a share of these networks. If you're one of the 300 million, this is why you need to keep hold of this stuff and stop fucking around with it, is if you are one of the 300 million and behind you, we've got 4 billion buyers to come.
Yeah.
Why the hell would you sell it?